So today I'm going to talk about a stock that I have completely sold out of. I've owned this stock for 5 years and I've made decent money on this stock over the last few years having this stock. However, I did make a bit of a mistake with it, and not a mistake like, oh, I've lost money on it. Those are the kind of the worst mistakes. Rule one is don't lose money in the stock market. But I think I could have done a little bit better with this stock. And today I'm going to show you where I could have done better, because as always, in this game, you're going to make mistakes. You are not able to see the future. You don't know where the top of the market is for that stock or the bottom of the stock. You can't tell. But you can try and put things into your favor a little bit. And there was things that I saw with the stock that I should have noticed. And in fact, at some points I did notice, and I didn't react quick enough to it. And as an investor, you're always learning, always learning. Even if you've been in the stock market for, 1 year, you're always learning. 5 years, you're always learning. 10 years, you're always learning. You're always learning in the stock market on how you can do things better. And today I'm going to share this with you guys, because obviously, yeah, it's great that I made money, and that's the main thing. As long as you make money, I always say to you guys, what we're here for at the end of the day, we're all here to make money in the stock market. That's the number one aim. But if you could do a little bit better where you're making even more money, that's the best outcome. So today I'm going to share with you guys, even if you're not interested in the stock, some little tips on how to improve on releasing capital. Because with this one here, I should have been a little bit quicker doing that, and I wasn't. And it kind of cost me a little bit. And yeah, it's okay making money, but I could have done a little bit better. So hopefully you find this a little bit useful. Now, you probably saw Friday last week, I actually talked about I sold all of the stock after 5 years, which was Jet2. This stock I bought pretty much at the same time. It was about 5 years ago, and I bought in the COVID lows of this stock, and I've held for 5 years, and I've let the stock go. And some similar reasons to Jet2, and we'll get onto that in a second. Just before you do though, I did drop a US portfolio on the Patreon. So if you're on the Patreon, go check that video out, and you get to see how my US portfolio is doing at the moment. If you are not on the Patreon, you can pay £3 to watch that video, or you can sign up to Patreon. You can pay £6 a month to join and get the 2 exclusive videos a week, or you can sign up annually and pay one lump sum, which I think is something like £60, which isn't too bad. But yeah, let's get stuck onto today's video. So the stock that I did completely sell out was one a long time ago, was actually my largest UK holding, which was Greggs. So I did completely sell out my Greggs position. I did buy during the COVID lows, and I did sell a good chunk of my position back out in 2021. But I held about 50% of my position until last week. On Friday, I did sell out some of my stock. Now, saying that, I still made a decent amount of profit on it. I think I made around about 30-something% on it. If you do add dividends over the course of the 5 years as well, that will push the return up to closer to 50%, which obviously is nothing to get too upset by, but I could have done a bit better. And the reason why I could have done a bit better is that I could have sold the stock out during this period of time up here, and I would have made a little bit more profit with that if I made that correct decision when it was back then. Now, why did I make the wrong decision and was a little bit quicker or a little bit slow to sell the stock? Well, so the first thing is this. So if you are on Patreon, you would have seen I did my UK portfolio for March 2025, and you would have seen my January and February edition for you guys. Now, in those videos, I actually said to you, I'm actually considering selling my Greggs position, and I never did. And that cost me, because then the stock ended up going a little bit lower. Now, why was I thinking of selling my Greggs position during that time, but I didn't sell it? So there's a few reasons why. If you do go back and watch that video, look at the holding size. So if you look at the holding size here, it's a relatively small position, like the Jet2 position, like the Greggs position. So the first thing is that it was a relatively small position in the portfolio. Now, because it's a small position in the portfolio, at the moment I had to do the same work for that Greggs position as I did for the likes of the Gaming Realms position, the JD Sports position. I was doing as much research for that position as them. And there comes a point where that time that you're researching into the stock, is it worth it for that position size? Probably not. So I should have been a little bit quicker going, look, it's just got to a relatively small position now. I've got to sell it and move on, because there's no point having it. Now, the reason why it got to such a small position is because I, first of all, sold a good half of my position out in 2021. I cashed some of it in for over 100%. I think it was 110% return, which was great. So one reason why is I did sell a good half of my position off a long time ago. The other reason why, and some of you guys will have this hopefully if you get very successful in the stock market, is that the longer you go on in the stock market, position sizes just come smaller. So I've not bought any Greggs since 2020. 5 years ago was the last time I bought some Greggs position during this time frame. Now, in 5 years' time, as you can imagine, what has happened in my portfolio is some of these position sizes here. These position sizes are a lot newer, or I've actively been buying a lot more. And because I've been actively buying a lot more, and because I have done quite well in the stock market, if you look at the stock market in the last 5 years, I've been in the stock market 4 out of the 5 last year since I started having Greggs. So because I've made so much money in the stock market, and also my contributions into my account have gone up a little bit since that time frame, my average position size that I was, compared to when I was buying during the CV times, my average position size is like 2 to 3 times bigger now, just because I've made that much money from the stock market and my contributions are bigger. So naturally the Greggs, because I've not bought for 5 years, the position size has started to fall behind, and then also you add in the big profit taking behind. So because of that, I should have maybe gone, okay, time and position wise, it's not worth having it. The other thing is that I wasn't actively really buying the stock. So even though it did start to have the pullback here, at no point did I think, okay, you know what, I'm actually going to be a buyer of Greggs stock. And even right now, with the dip that's been on, I'm still not actively buying Greggs. So what's the point of having the stock in the portfolio? And like I said, the reason why I'm not actively buying Greggs at the moment is because when I look at the stock is still currently 13 times earnings. That's okay. It's a bit cheaper than where Greggs historically has been, which, by the way, this is something else that I did wrong, is that I was looking at Greggs and I could see that, okay, Greggs was about 20 times earnings. And at 20 times earnings, I should have gone, right, Greggs is realistically not going to go to 25, 30 times earnings. It's not going to have any metric expansion. That's about as much as what Greggs has been valued on. And in my head, I can realize I'm doing the numbers in my head about, okay, revenue growth, profit growth, let's call it 4 or 5% a year. No metric expansion. There's not that much upside. And I should have really been a bit more quicker on the numbers, running them, going, there's not much upside from these numbers. I've got to sell the position. And this is another thing as well that some people don't realize, is that when it comes to investing, and especially me, this is something that I like to do, is that when I buy some of these stocks, I'm not just buying them because the financials are improving. So, the business is growing like 3, 4, 5% a year. If a company does, if it grows, then more than likely the company will be worth more than what it is right now. But one of the main reasons that a stock can do really well, and is probably not talked about enough on the on YouTube, is metric expansion. And from one point of view where the stock can be valued significantly lower on a metric point of view, and then it gets valued a lot higher. That's one of the big things that can move the share price. So something like a JD Sports right now, I'm buying JD Sports because, okay, financially I think they'll do well. I think they'll grow 4 or 5% a year. But right now it's being valued at like 6 times forward earnings. Realistically, I think that should be 12 times earnings. So I'm not only just factoring in a growth of the financials, I think the market's valuing it wrong, and then it'll go on to do really well. So that's also another way that I'm kind of hoping to make a bit of really money from that situation. With Greggs, I don't think that's there now. But if you do look at Greggs, is that there was a time where people did not want to have it. I don't know if it'll be on here because this takes it from the end of the year, but let's just say the CV lows. At the CV lows, Greggs was valued at like 12 times earnings. At the Liz Truss period of time, it was valued at 12 times earnings. Right now, we're at 12 times earnings. So what you have here, why the share price has dropped so much with like Greggs at the moment at these periods of time, it's not just because the financials have deteriorated that much. The reason why this value has moved so much on Greggs is the valuation metrics. The market has decided we don't like Greggs, so we during these periods of time, it shoves it down to 12 times earnings. During this time, the market loves Greggs and it puts it up to 20 times earnings. That can be one of the big movers from it. So when the stock was up at 20 times earnings, I should have gone, it's not going to value it probably more than this. And then obviously we've had the metric compression, and that's why it's gone down so low. And I even when I made the video the other day, I think it was maybe JD Sports, I made the video on it. And I said and I could tell it sometimes in the comment section. And that's why I love doing YouTube, because I can get a feeling around the sentiment of a stock. And the sentiment of the stock of JD Sports was like, oh, it's a trash stock and everything like this. Everybody's not wanting to own it. And that's why, that's where the market's at. The market's valuing it like it's a complete dud, right? All it takes is some little positive news to come out. Let's say if JD Sports start, hitting the guidance or something, and then they put strong guidance out, all of a sudden the market will go, oh, that's actually quite good, and then the momentum can change so quickly on it, and that can happen. It makes me laugh that people don't really realise that. But that's how it goes sometimes. And I should have been a little bit more like, okay, the market's not going to love Greggs anymore than what it is right now. Be a little bit more careful. And that's why Greggs has fallen so much, because we've gone, to such a low sentiment right now. But the point that I was about to make before I went on that little bit of a talk there is that even at where it is right now, which is like 13 times earnings, I don't like this stock enough to go buy it. If you look at my portfolio right now, on the Patreon UK portfolio review that I did, if you look here, I'd rather go buy JD Sports. I'd rather buy Hollywood Bowl. I'd rather go buy Game Realms. I'd rather go buy Card Factory at the moment. I'd rather go buy B&M. I'd rather buy Warpaint. In my opinion, all of these businesses are in a better situation than Greggs. In my opinion, they've all got better growth drivers for the next few years. They're also better valuations. And because of that, I'm always going to buy them over Greggs. So it gets to the point of view, why only stock in the portfolio? Cash it in, small position. I could use that money to go buy other stocks. The only thing is that I should have done it a little bit quicker when I could see that the valuation metrics had been really expanded, and I didn't. And that kind of cost me a little bit there. The third reason why maybe I made a bit of a mistake and maybe a bit slow to do it is that I knew, when I talked to you guys there, I think you can tell, I knew it was a small position and there's no point to have it in. I knew that. I'm telling you guys that, but I knew that. I even said it on when I was doing the videos on Patreon. I even called it out on the Patreon when I was talking about it. I knew that Greggs was quite fairly, richly valued. I talked about it many times on the Patreon before. So I knew these things. So why didn't I still sell? And this is something that I've maybe not mentioned for a little bit, but it's something that I call green eyes. Now, I'm half debating whether or not to change the name to this to greedy eyes, which I don't know which one sounds better. But what I call it is, green eyes. And what happens is that sometimes, and you can, even right now, from this video, you can tell I get a little bit guilty of it, is that what can happen is you can get caught up on a stock being up. So for example, especially with the dip that was going on in the UK stock, in the UK stock market, and a lot of stocks being down, it's sometimes really nice to have that green stock in your portfolio, and you look at it and it makes you feel better. You're like, oh yeah, but look how much I'm up on that one. And it's nice, it's a nice thing to look at. It's nice to look at a position and look how much you're up on a position. The problem is that it doesn't make you money, and stocks are not loyal. And if something goes wrong with that stock, as we've kind of seen, a sentiment change with what we're seeing right now in Greggs, 42% within a 6-month period. Sentiment can change very quickly around that stock. And that stock that you've enjoyed looking at, that stock that you've got green eyes looking at, and how much you're up on it for the last year, 2 years, can very quickly turn. And then all of a sudden you're like, oh no, it's gone and I've got nothing to show for it. We're getting a little bit onto another stock here, but the exact same thing happened with Hims and Hers. Hims and Hers went up 1,000%, and it was lovely and it was great looking at it. And, it's great having a screenshot of it and looking at it going, look at how much I'm up on there. But it don't make you anything. It don't make you any money. That screenshot isn't going to make you any money. And what we're all here for, we're all here to make money. And stocks aren't loyal. And very quickly, them gains can go a little bit. And that happened with Hims and Hers. And a few people got a little bit upset when Hims and Hers had the pullback that it's had at the moment, because they were all up so much and then they took no profit. But if you did take profit, you're kind of looking at, at the time you're like, oh, okay, I'm going to have to sell. I don't really want to sell because I like looking at how much I'm up, and maybe a little bit heartbreaking. But, you got to have no emotions in this game. And, you click the sell button, well, not the full sell, but maybe like a little bit of a trim. You do that little bit of a trim. And then when the stock goes down, you think, you're in a situation where you go, thank God I took some profit there. Greggs right now, I'm all right with that, because obviously I locked over half my profit off at 100% gain. But if I was selling now after being up at these highs, and I was having to sell it all for what I did sell it at, I'd probably be a little bit devastated with that. And that's something that you've got to be really careful of. Like I said, I personally don't do it that much. But as you can see, there's still times where I do make those little mistakes there. And especially, I think especially if you're a new investor, you do it quite often. So that's something that I think is quite useful to know, is that, you know, it's very easy to get green eyes in this game and look at things and go, look at how much I'm up. But, you know, very quickly, if that stock pulls back 40% and all you've got left to show for it is a screenshot, I tell you something, you'd rather have locked a bit of profit in and be looking at that profit and going, you know what, well, it's pulled back now and I've got profit, I can go buy back in at this dip. You'd rather be in that situation. So that was also maybe something that kind of played into me as well, potentially, especially with the dip that the market's been on. And I've not really made a mistake like, you know, green eyes or greedy eyes. I've not really made a mistake like that for a long time. But that was maybe another, you know, part of the factor there. I'd say maybe 25% of the factor. So, yeah, I just made this video today because, like I said, you know, it could be worse. You know, at the end of the day, you know, a mistake of making money isn't a terrible mistake, because that is, losing money is the number one mistake that you try and avoid in this game. But could I have certainly done better with this investment? Yeah, probably. Yeah, you know, probably I could have done a little bit better. And hopefully, like I said, you know, the reason why I made this YouTube channel, and going back to when I first started this YouTube channel, is that as an investor, you know, I'm doing this, I do a lot of research on stocks, and the main reason I started YouTube with the stock market stuff is that I'm doing all this research, and then when I've done this research, that's it. But if I put it on the internet, you know, people that are maybe looking at that stock might find that helpful. That's why I started the YouTube channel originally, is that I wanted people to look at the research that I've done, and even if it was just 1 minute of the 10-minute video was useful, I've helped someone on maybe that investment journey. And then it's kind of, you know, developed a little bit more since then, where I start talking about a few more different things. And today, you know, that one thing is that, you know, I personally made, you know, not a terrible mistake, but I could have done better. And one thing to improve from, and me sharing that video on here, hopefully you guys, you know, it helps someone improve, and, you know, whatever that might be on what I've done in this video, and maybe that, you know, one of the points where I could have done better, it helps you, you know, whether it goes down to what's the point of having a small position and doing the research from it, whether it be a point of view of like, why hold the stock that even if it drops 45%, you're not willing to buy, and if it's a 13 times earnings, you know, and you're still not buying, you know, why are you not putting that money into other stocks that are dipping a lot quicker? Maybe it's a point of view of looking at the metrics. You know, you run the numbers, and if you can see there's no upside left on it, which I did, you know, why continue to hold it as I did? Maybe it's a point of view that just a reminder of that green eye situation. You know, stocks are not loyal, and sometimes, you know, you can get caught up in that cycle of like looking at gains, and then, you know, the stock's not being loyal, and all of a sudden the market throws it under the bus, and all you've got to show for it is a screenshot. You know, you're a little bit devastated. You know, that's not what we're here for. We're not here to take screenshots of the, you know, how much you're up on a position. Don't get me wrong, it's lovely. It is lovely taking a screenshot, but, you know, at the end of the day, you know, what we're all here for, we're all here to make money. And, you know, if you're not making money, what are you doing it for? You know, I mean, it's enjoyable, it's fun, I enjoy doing it, but your main aim has to be to make money. That's why you're doing it. If you're not making money, then there's other things that you might as well go do with it. You know, you might as well just go stick it in an index or bonds or whatever. So, you know, you got to make the money from it. And yeah, don't get me wrong, like I said, we made money from it, but could I have done better? Yeah. And that review today is like me saying, like, that's where I could have done a bit better with this investment. And yeah, I mean, it's good. It's another profit, you know. I'm certainly sure there's probably worse mistakes that I can make, but certainly some improvements that could have been done there. So that's the video for today, guys. Hope you enjoyed it. I'll see you all on Friday. I'm not sure what I'm going to do yet. I'm half tempted between a Card Factory video, and depending on what happens with earnings tonight, maybe a video on maybe Nike, or maybe a video on PDD earnings. We'll see what happens. Yeah, it's all up in the air. Sometimes the thing with YouTube is that you try to plan ahead and you can't really plan ahead because, you know, things come out of nowhere. So we'll see where we're at tomorrow anyway. Thanks for watching anyway, guys. Hope there was some useful bits in there, and see you in a bit.